The second is just some protocol in terms of the webinar. Everybody seems to be doing a great job, and that is muting your microphones.
Please.
Microphones when so sorry that I'm going to have to do it centrally for some folks. So because we are recording and it does interfere with the webinar itself. We will be recording this. We will be making it available on the CyberWatch YouTube channel. If you go there, you can go to nationalcyberwatch.org, and there is an events link in the upper right, and you'll see a link for the cyber insurance webinar here. And if you click on that, I've got the presentation slides are already available, and this page here will have a link to the CyberWatch YouTube channel where the recording will go. We will take questions as we go throughout, so I prefer folks use the chat feature. I know not everybody is logged into WebEx. Some of you are dialing in by phone only. We'll make some time, though, as we progress and to ask questions and get some answers from Andrew. The only other thing I want to say before I turn it over is next week is the RSA conference, and there's been a buzz around cyber insurance. And I read one article specifically that was, asking the question: is the industry ready for cyber insurance? What will the discussions and some of the presentations at RSA be like? So I thought that was interesting. But without further ado, I want to turn it over to Andrew. And Andrew, the show is yours. Thank you.
Thanks, Casey, and thanks everyone for hopping on this morning. Looking forward to discussing the world of cyber insurance, and it's constantly evolving right now. So if we go to the second slide, it's a brief background on me and the group that I'm in. So I'm part of Aon's Professional Risk Solutions team. We're a group at Aon that is strictly dedicated to a few lines: errors and omissions liability insurance, media liability insurance, and the most recent and most prevalent right now is cyber liability insurance. So we have 50 dedicated professionals across the U.S., London, and Bermuda. We've placed over $400 in premium, last year alone. We've handled over 200 claims since 2012. We have over 1,500 clients, and this is an area that we have spoken with existing clients and then prospective new clients a great deal over the last 12 months. So looking forward to speaking with you all today. Going to the next slide, slide 3. What is cyber liability insurance? It's first thrown around a great deal, and to me, I find the word cyber and liability combined with insurance to be actually misleading. And I'll get to this in a little bit, but it goes beyond what you think of when you think of just a hack. Cyber insurance really is designed to pick up any sensitive data and any sort of breach of that sensitive data that you're entrusted with, and the potential first-party and third-party costs with that. So if we move to slide 4, you can kind of see there's a list of bubbles of emerging and growing threats in this space right now. And so the big ones you see here, you think about vendors. Organizations are oftentimes outsourcing their sensitive and very critical data to third parties. Think about HR outsourcing. They're holding your organization's social security numbers of your employees. Health records. Records is an interesting space right now because it's one of the few areas in the cyber world that has some pretty strict regulatory guidelines around it, and those are surrounding HIPAA, with how to keep and protect healthcare records. Obviously, with natural add-on there is cloud, outsourcing things to the cloud. It's BYD policies. So if your organization is letting their employees use their own personal devices that are not owned, operated, or leased by the organization, but actually owned by the employee, what are the ramifications of that scenario, and where's the liability fall if there is a breach STEM BYOB device that, again, does not belong to the patient but belongs to the employee. Even into the media world. So thinking about the content that you post on your website and whether the content is legally allowed to be there. So think about copyright holders for images on your website. There's liability associated with that. And so that's just a handful of the emerging threats and some of the things that we're beginning to think about and the insurance industry is beginning to think about right now. Before moving on, just to be clear, is actually an insurance broker. We advise clients about their risk and about the insurance market overall. So Aon is not actually an insurance company, but more of a advisor and risk insurance placement brokerage to help clients get the insurance that they need. So we scour the market and see what the insurance carriers are up to in regards to appetite in regards to cyber insurance. So I think that is good level set. Slide 5. The term cyber liability is quite misleading. It construes this image of overwhelming hackers and the guy at this keyboard right here. I find this image actually pretty frustrating because it is limited in scope. It's implying that this insurance is only for someone coming into your network, they're typically from Eastern Europe or Southeast Asia, and extorting you for money and then taking your data. Cyber insurance is much broader than that. So, like to say network security and privacy. That's actually what a lot of these policies are called, because that's actually a more comprehensive and accurate description of what they're actually covering. And liability, so liability, so we get rid of cyber and make it network security and privacy, and get liability altogether, because liability implies that this is a coverage that only comes into play if you are liable for something and are sued or have a demand from a third party for money. This insurance goes beyond just a third-party demand or a lawsuit, and it covers first-party costs. So costs that are directly paid out of the organization's pocket, typically in the immediate aftermath of a breach. So when you think about these things, you think about the critical steps an organization needs to take in the immediate aftermath of a breach. So IT forensics, legal advice, notifications, things like that oftentimes if you do in a timely manner, you'll never get sued and the liability won't come into play anyways. So this image is misleading, and it always frustrates me when I see a cyber insurance white paper have something like this with a guy with a hoodie on, typing in code very and the thing is, it's designed to pick up any sort of unintentional acts or offline activities. So when you think about this, you think about employees or sending information to people that they shouldn't have. The HR department is outsourcing information or sending information to a third party, and they actually send it to the wrong third party, and that information has social security numbers in it. That's a very unglamorous but actual data breach. And these policies are designed to pick up things like that as well. So going to the next slide.
The picture is in a ski mask. So
I always wondered about that, and they're also wearing leather gloves. What I want to see on these white papers is, sure, we can have the hacker, but I also like to see a stressed out sales executive at an airport who lost his laptop, and I also want to see an HR employee freaking out because they sent a spreadsheet to the wrong person, because that's a much more comprehensive depiction of what cyber policies are designed to pick up. And so next to the slide here, what is cyber, is kind of a visualization of what I was just getting at. So online and offline. So when you think about offline, lost laptop, it's holding sensitive information, and that information is unencrypted. That's going to trigger breach notice in a lot of states. A number of states right now say that if the information is encrypted, you can notify anyone. So one of the things that cyber insurance carriers love to ask is detailed questions about your encryption practices. there are strict end-to-end encryption practices in place, chances are that there is no notification obligation at all in your state. So it's a smart way for them to avoid a lot of potential risk there. So that's the who. We got malicious, accidental, internal, and external. So again, beyond just a hack, but it can be an accidental disclosure of information, and if it involves something that you're entrusted with, it's going to probably trigger notification obligations. Obviously, technology, media, and protected data. These are the core things that these policies are designed to get at. Any failure of technology that results in a breach or a potential outage of your network, which leads to a business interruption loss, it's designed to kind of cover that scenario. You can imagine where the financial impact of data breaches is. This is oftentimes kind of buried in these cyber breach articles that you read about every day. We read about the number of Social Security numbers and the amount of impacted people, but oftentimes we lose sight of the costs of all this. And so we have an IT forensics firm that's, basically the technologic equivalent of a firefighter coming in and trying to figure it out as soon as it happens. They're cheap. And so when you have an organization charging you $1,000, $1,500 an hour to figure out your data breach, it's much like a building burning in the sense that you don't have a lot of time to negotiate with them. The building's burning down, the data breach is going on, you need to stop it right then and there. So you can quickly see how both from first party, so direct costs out of your pocket, and from third party, if say a lawsuit is ever brought, the data breaches can quickly add up from a financial standpoint. General overview of cyber's designed to cover. Next two slides are actually line by line the actual insuring agreements. So, third-party standpoint, again, third party being a demand or suit brought by a third party for a breach of information or a breach of your network security. These coverages are designed to pick up. So when you look at security liability and privacy liability, these first two bullets on this slide are the core of any quote-unquote cyber policy in the market right now. This is network security and privacy liability policies because of these two. When you think about security liability, this is designed to cover any liability stemming from a failure of your network security. So this is your kind of hack scenario. So network security fails and you become liable for that. Commonly seen with the data breach. So there's a failure of your network security, information is stolen, you could be held liable for that. The network security is also designed to pick up scenarios that don't constitute data breaches, but areas where you could still be held liable. So one example you think about here is your organization transmits a malicious code or a computer virus to a third party. That party then suffers a financial loss. And there's no information breach there. There's not kind of a large-scale data breach. That's your network being liable for the loss of a third party, and then them coming after you and suing you. So this is your very technology-focused agreement from a liability standpoint. This deals strictly with computer security. Next one down is privacy liability coverage. This is your catch-all to sensitive information. So the first is focused on your computer security and liability stemming from that. This covers stemming from your failure to maintain and protect private information of third parties. So when you look at the paragraph there under privacy liability, look at the second line, and right in the middle it says whether or not due to failure of security. So this is designed to protect you from any lawsuit or third-party demand who accuses you of losing sensitive information that you've been entrusted with. So it can be online, so again, a hack scenario where they take information from you. This can be offline, so like a lost laptop. This is paper files. So if you have paper files that contain sensitive information and those go missing, that's a data breach. We've seen a couple examples of baseline paper data breaches. One, there was a pharmacy in Colorado, and they were improperly disposing of paper files of their patients who were picking up prescriptions, and an investigative journalist was digging around and found those paper files in the dumpster, and they were not properly disposed of, obviously, and with a fine from the Office for Civil Rights for improper, of healthcare information, which is mandated under HIPAA. So they got fined for that. Also heard an example of a tornado hitting a building and paper files across a field and triggering a data breach. Again, it's kind of your catch-all for any sort of information that you are responsible for that you lose.
Andrew.
No, go ahead.
Oh, I'll wait till you're done. We just had a question from the chat room, so.
Okay, I'll finish up this next bullet, and then we can go take the question. The one on there is privacy regulatory proceedings. This is a liability coverage designed specifically to pick up any regulatory body that may be investigating or litigating against you and the potential fines or penalties stemming from that. So this is just kind of a dedicated limit for regulatory outside of the security and privacy. This is some sub-limited because this can quickly add up. When you think about the regulatory space for cyber right now, I mentioned the Office for Civil Rights. They're the biggest one. They're the ones who enforce HIPAA. So holding healthcare information, this is an insuring agreement to focus on because you have a great deal of exposure if you have a lot of healthcare records. We've seen space kind of evolve lately. In September of last year, we saw the SEC fine an organization for the first time ever for a data breach. There was an asset manager who had a breach, and after investigation by the SEC, the asset manager was found to have had zero business continuity plans and disaster recovery plans in place, even though they actually handled the breach fine and they notified the affected parties. The SEC investigation basically found that you guys were winging it, and there was no plan in place for this, and they fined them accordingly. We've seen the Fair Trade Commission, the FTC get involved in this space. Very much cyber that is in flux as we see regulators find out that this is a very profitable way for them to make some money. So, I heard we had a question?
Yeah, a couple. So we have one question. The security liability events, DSSA, virus and unauthorized use, et cetera, are all different in terms of client responsibility. Does the policy differentiate between them in terms of rates paid?
No. This is one bucket of money on a policy. So they typically don't get nuance into things like that.
Question. How do you currently assess the risk of performance of staff in preventing, responding to, and mitigating breaches? Is there an errors and omissions complement to professional liability insurance?
So, you mean the biggest risk for organizations is their people. You put the most money into the greatest IT infrastructure on earth, but one employee error is still going to set you back, just like a complex hack would set you back. What carriers really look for is they look for employee training practices. When we submit an application to a carrier for a cyber quote, obviously there are some basic questions that they're going to want to know. However, in this space for now is as much of an art as it is a science. So, they have their rating systems and they're going to spit out a number, but the more we can demonstrate proactive employee training or business continuity planning or tabletop exercises or encryption practices, the more leniency the carriers will have from a pricing standpoint. One very common thing we've seen from some insureds is doing phishing emails. So those out there who will phish your employees, and those who click on the email that they shouldn't be clicking on will then be signed up to do a training seminar. That training seminar, they'll be phished again to see if they click it and learn their lesson. And so it's things like this that we are really seeing as insurance companies really begin to stress among their employee base, and these policies are designed to pick up accidental employee error. Where you coverage stop is if it's with knowledge from typically C-suite. So if the CEO says, hey, you guys need to disclose this information publicly, there's going to be no coverage there because that's an intentional act. And you cannot sever the CEO from the company because they're kind of one and the same. But severability for your rank and file employees so that the coverage would be in there.
Excellent. We have one more question, then we can go on. It says, do you cover ransomware?
And we will get to that actually in a couple slides.
Okay. One more, and then how about one more and we go on. Does cybersecurity insurance have an educational call to action impact, such as clients adding, I think it should be BYOD policies, changing network topology, or re-looking at vendor service level agreements?
So one very positive impact of cyber inquiries is that it does ramp this up on the radars of the suite of our clients and our clients' boards. One of the easiest ways to get attention of them is to fill out a cyber application. So we'll send an application to prospective insureds. They'll look at it, and sometimes we won't even talk to them again, but they'll come and say, this prompted a lot of discussion internally. And this is rising on the radars of, again, the CEOs and the boards of our clients. And it is having kind of a domino effect, and some of the things you see are, reevaluating vendor contracts and evaluating the current practices and determining whether this, risk transfer method via insurance is something they should consider in combination with, again, ramping their internally.
Great. Keep questions coming. Why don't we go on, Andrew? Thank you.
Yep. This is another slide of third-party liability. So we have two slides of third-party, one slide of first-party. So these are the more ancillary third-party coverages. So media liability. This is basically exactly what it sounds like. It's liability stemming from any content that you disseminate online. And as I mentioned on the slide with all the bubbles, what we see is using an image on your website, and you from the image holder to use that image for your commercial purposes. The copyright holder will then levy a lawsuit against you, and there are loss and damages associated with that. This is very much kind of an add-on to cyber policies. These are not the core intent of a cyber policy, but they are obviously a great addition to include. PCSS, or Payment Card Industry Data Security Standards, covers penalties or assessment fees levied against an organization that has a large breach of credit card numbers when assessment or fine or penalty is brought by the payment industry. So when you think of this, the similar with regulatory being very important for healthcare organizations due to the fact that they're healthcare records, PCSS is really applicable to organizations that are processing a good deal of credit card transactions. Think about this, you think about retailers, think about very, very large universities that have bookstores across the campus that process credit card transactions. Because this is the payment card industry will levy a fine or a penalty to large credit card breach scenarios. So this is your MasterCard, your Visa, your Amex, rate completely independently of any regulatory body to enforce the data security standards that they organizations who use their cards. So it's very big for organizations processing a high volume of credit card transactions. Third one on here, extortion. So this was just brought up. This covers not the fine, but the payment of an extortion demand. Actually, last week we saw a hospital in California get it for $17. Excuse me. The insurance on these policies designed to pay that ransom fee. That also will pick up the IT forensics associated with that ransom. So the cyber extortion they're typically not high dollar demands. They're coming from parts of the world where the dollar goes way further than it does here. So think about Eastern Europe, Southeast Asia. And so we've seen, demands of $500 to $1,000 to $1,500. They're not huge, but where costs add up is after the demand is paid, getting a vendor in there to figure out and to make sure that is not still in your network and can extort you again. That costs really add up on cyber extortion, and that's what the policies are designed to cover.
Andrew, do you mind if we take a couple more questions?
Yeah, sure.
So let's see. We've got have their own risk framework for assessing the IT environment, or is there certain industry frameworks they use, ISO, NIST, etc.?
NIST right now. So that definitely, when we have large, our large Fortune 250, Fortune 500 clients, the risk managers can't speak educationally about their IT infrastructure posture, and a lot of times we'll get the CIO or the CISO to hop on, and NIST is very much something are asking about now. So that's what I would say the main framework they're looking for is.
To be clear, we're talking about the NIST framework on infrastructure security for folks that are interested in that. Kind of tangentially related to that, you mentioned that the underwriting process is a bit of an art at this point, right? So how do underwriters assess an organization's cybersecurity profile or evaluate prospective clients?
So you typically look at 5 or 6 things to start. And these are very general categories, but starting from the top, they look at industry. So, obviously, healthcare, retail, and financial institutions are very, very high risk right now. For obvious reasons, they're holding a lot of data. So they're looking at industry, they're going to look at revenues, they're going to look at the type of information and the quantity of information that you hold of third parties. Healthcare, retail, and FIs are so hard to write right now. We have industry, revenues, quantity of data. We have encryption practices. As I mentioned, encryption triggers safe harbor in a number of states. They're reducing the notification obligations. They look at business continuity and disaster recovery plans. So, business recovery plan or business continuity plan in place. And then the third one is the overall state of your IT infrastructure. And that's a bit of a more broad, sweeping category, but it looks at things such as use management, data classification standards, things like that.
Thanks. And we have one more, and then we'll go on to the next slide, which is how valuable would a performance-based assessment or certification for employees that could standardize maturity level estimate of cyber skill be in the science of risk estimation? Is this something that insurance companies would be willing to support?
I don't think it wouldn't. We were seeing now that the carriers are becoming more advanced in the questions they're asking and the way that they're underwriting this risk. You look at something like revenue, really doesn't have a lot of applicability to cyber exposure, but that's basically built off the fact cyber policies are kind of morphed out of professional liability policies, and professional liability policies, their core rating base is revenue, and so it's kind of natural carry-on. So I think as we progress and as carriers become more educated, we're going to see things like revenues matter a whole lot less, and that matter a whole lot more. And we're seeing carriers completely applications become more honed in on the things that are really critical in regards to rating a risk.
Great. Keep the questions coming, everybody. We'll go to the next slide, Andrew.
And so this is the final slide of the coverages, and this is first-party coverage. I argue that these are the most important coverages of cyber policy because keep in mind, those 2 slides we discussed are all triggered by a demand of a third party or a lawsuit of some sort. So first party, these are costs directly incurred to the organization. And so expenses, they are the most important insuring agreement in a cyber policy. The reason for that is these are directly incurred in the immediate wake of cybersecurity incidents or a breach of sensitive information. So this insurance agreement, it's going to cover 5 core things. It's going to be IT forensics, similar to a property policy. With a fire burning down a building, you need to have someone figure out how that fire started. Same exact logic with a data breach. You need to get IT forensics in there to figure out how the breach started and if it's stopped. You're going to need to get legal advice as to how you need to notify the affected parties. There are only 47 different state notification laws, all stating what a particular resident of that state needs to be notified about if their information is breached. These vary quite drastically. So, for instance, there are 6 states in the U.S., I believe it might have now, actually, I think Connecticut just added this, that all say that a piece of biometric information is something that a resident of that state needs to be notified about. So, Wisconsin, for instance, my state, is one state. So if my fingerprint is breached and I'm a resident of Wisconsin, I need to be notified of that per the state laws. If I'm say Arizona, there's no law on that. I don't need to be notified about that. And it's a giant legal spider web of notification obligations. You'll incur legal costs about that. After your legal expenses, you'll then actually notify the affected individuals. This is done typically through a communications vendor who can send out letters on your behalf. And then I would say the next 2 are more not but they're not going to be a part of every single data breach. Consumer credit monitoring expenses. So this is something a few states enact so for instance, Connecticut this year just enacted a law saying that any business that has a data breach needs to provide 1 year of credit monitoring services to the affected parties. Social Security numbers need to be involved for that to be triggered, but we're going to see credit monitoring become more and more of a legal standard in some states. And so if numbers are involved, you may have to incur consumer credit monitoring services, and those add up quite quickly if you have a significant uptake of the affected parties taking up your services or the credit services. One is public relations expenses, and this is in the event that you need to manage the communications surrounding your data breach from a proactive standpoint or a reactive standpoint if a journalist gets wind of it and starts asking you questions. So these are going to be incurred in the old data breaches because you need to handle this regardless of whether you get sued or not. So we do see these get triggered, the most out of any of the insuring agreements on our policies for obvious reasons. Next one is network business interruption. This is basically exactly what it sounds like. It's picking up where a lot of property policies are throwing exclusions. They're throwing exclusions for interruptions of their network. This covers a failure of your network security that leads to a business interruption loss. So if you have a hack of your network and you are unable to, say, manufacture widgets for 3 days, or you are unable to sell products on your website for 3 days, and you can demonstrate a tangible financial loss because of that outage, this would basically cover the costs, the lost revenue costs there. And so, we are seeing an uptick in this. The business interruption is dependent, again, on failed network security. So it has to be kind of a hack scenario. There's a build off of this coverage, and it's right in the middle of that paragraph. It's called system failure, and that has been something that is very new to the market, but has seen a great deal of interest. And system failure, what that does is it moves the requirement of a failure of network security from the interruption insurance agreement. So it covers loss to your network, regardless of how that happens. And what that does is that picks up internal errors. So oftentimes we will see upgrades go wrong or updates go wrong, and the network is taken down for a significant amount of time, and there's a loss incurred. Business interruption wouldn't pick that up because that's not a failure of network security, but system failure would. And so this is, again, something that not a lot of carriers are offering right now, but it is becoming about more and more frequently. The waiting period that applies to them, which acts like a deductible or a chin, and between 10 and 24 hours. The one on there is digital asset protection, and this is also designed to pick up where a lot of property policies are throwing exclusions. Policies throw exclusions for intangible assets, so destruction of intangible assets. This is designed to cover that. So this covers the vendor in to restore any intangible assets or data, software, electronically stored customer databases, credit cards that are damaged, deleted, or destroyed in a hack. So they will get you back to where you were if they are destroyed in a hack scenario. So that's the first party side of things.
Excellent. Andrew, thank you. A couple questions. Back to first party coverage. Do any cyber policies also cover board of director negligence? I think suits in this area have failed to date, but the fact that there have been suits has heightened board concern with personal liability.
So under a D&O or directors and office liability policy, which is a separate group here, but that's something we're getting asked about a lot because when it gets to individual negligence of the board, it would fall actually under a D&O policy.
And then there was another one. How developed is the actuarial database of cyber losses? Are they shared across the industry, the clients?
Question. That's part of it's not that big because it's not like property insurance where you have 50 years of actuarial data to basically set your rates on. Cyber insurance was first offered by AIG about 15 years ago, and we didn't see significant losses until about 5 or 6 years ago. And actuarial data is very light, and information sharing on losses is it's very limited. So carriers are not sharing information with other carriers, and because it's so sensitive, it's valuable right now. So unfortunately, that has not been as strong as I think it will be eventually, but that's a good question.
Okay, on to the next slide. Thank you.
Next slide, this is just kind of a visualization of the 3 slides that I went over. So the red box on the left is your liability. The green box is the first party loss, so your business interruption, your system failure, your intangible asset damage. And then the pink box on the right is the expenses paid to vendors. So that's your privacy event expenses, your IT forensics, notification, legal, things like that. So I mean the two right are first party, the square on the left is third party. So just another way to look at it. I thought I would go over just some cyber statistics that we've been talking about internally here. This first one is claims by revenue size. So what this is getting at is that smaller organizations experience the most incidents, and we hear about that in the news. We're hearing about Target and Home Depot. In reality, a lot of these cyber incidents and claims are stemming from organizations of under $2 billion in revenue. And so it's a lot easier to go rob your local bank than it is to go rob Fort Knox. Same sort of thing with cyber criminals who try and hack, a Fortune 50 company. They have a lot more resources from a standpoint than, say, a smaller mid-sized company does, holding valuable information. So it's kind of what we're seeing. This is a slide that goes back that it's not all hacks and it's not all malicious extortion attempts for information. 50% due to human error and system glitches, and you think, like I said, lost laptops, sending information to the wrong party, more accidental events than intentional malicious events. Right there, you see the cost of breach is much more expensive for a malicious attack than it is for a human error. And the reason that is that with malicious criminal attacks, those are typically scenarios, and those are going to incur significant IT forensics costs. So you're going to need to spend a significant amount of money to figure out how the event happened. Whereas human error, your forensics are pretty simple. It's, oh, I sent the spreadsheet to the wrong person, or I lost the laptop. There's your IT forensics right there. So it's a lot cheaper because you're kind of axing the IT forensics there. Unfortunately, this is an area that is evolving quite rapidly, unfortunately. Seeing two main areas, so property insurance and general liability insurance. As I mentioned on the insuring agreement slide, property insurance is throwing a lot of exclusions to exclude cyber risk that they never intended to pick up when they wrote these policies initially. So for intangible perils, so that would be a business interruption claim, and intangible property, so your software, your data, your customer databases. So those are being thrown on there, which is what the cyber policies are picking up. General liability insurance, we've seen organizations try and get coverage seeking under the language publication or utterance of private information. This was tested in a court case of Sony v. Zurich a couple of years ago. So before the Sony North Korea, the interview, that movie hack, Sony's PlayStation network was breached in 2011. They lost tens of millions of records. So coverage for this under their Zurich general liability policy. They pointed to this language saying, you know, there's publication or utterance of sensitive information, so we should get coverage under our GL policy, our general liability policy. Zurich said, you guys didn't publish anything. It's stolen from you, so we're denying coverage. And in that case, and that kind of set precedent, and GL policy is not picking up cyber risk. And so there's a definite gap to be filled of cyber insurance policies.
Questions from the chat room. So one is, how many of the malicious attacks are due to a human error in failing to adequately protect, monitor, detect, diagnose, or correct system vulnerabilities?
I could put a number on that. I would say, from at least anecdotally, from the claims that we see at Aon from our clients, the rate consists of accidental and laptops rather than out attacks. And I don't think this will change in the near term. I think this is going to be a trend that continues.
Another question, is it possible the slide with malicious attacks and human error is minimizing the impact of human error or performance failures in creating cyber risk? Is it possible to slide with malicious attacks and human error is minimizing the impact of human error or performance failures in creating cyber risk?
Boy, question. You know, I think about that one. Can I get back to you on that?
Absolutely, absolutely. Yeah, that came from Dr. David Toby. So we can get back to him. Sure, and then just one more, and it's back to the first-party policies. Specifically, how granular are the first-party policies? Does types of protocols, for example, HTTPS or HTTP?
No, they do not get that granular. The thing that the level of granularity that we pay attention to as brokers is things like does policy respond for voluntary notification of affected parties, or does it only respond if there is a state mandate to notify affected parties? Policies right now have voluntary notification and you know, things like vendor flexibility. So some insurance carriers may use a specific list of their vendors that they have pre-negotiated rates with, whereas kind of say, hey, as long as these are reputable vendors, you can use whoever you want. So that's the level of granularity that they're getting to. They're not getting into you know, HTTP issues.
Excellent. Thank you. How about, would an errors and omissions add-on to a GL policy cover cyber?
It could. We typically like to avoid adding cyber via endorsement because those tend to be very light, and coverage has evolved quite drastically even over the last 5 years. We've seen carriers come out with new forms. A handful come out with new forms over the last year, and a few coming out with new forms this year, and that's because this is constantly evolving. And there is absolutely the possibility to get coverage on an E&O form or a professional liability form with a endorsement, but we have to be wary of those because the chances are their coverage is not as broad as it would be on a standalone program.
Great. Okay. Let's head to the next slide then. Types of data breaches in higher education.
So this is just a slide I took from an EDUCAUSE white paper. It basically shows that hacks and unintended disclosures make up the leading data breach causes in higher ed. Hacks and malware, one thing that higher eds are susceptible to is their engineering and their technology departments. So we've seen, as well in the next two slides, a few high-profile breaches of large academic institutions to engineering departments from China. And that's because chances are they're holding sensitive information, potentially of third parties, organizations that they're doing research with that could very much benefit a foreign. And then disclosure, this is kind of industry agnostic. We see unintended disclosures in every industry, and there's a few examples for higher ed that I'll go through over the next few slides. View of URMIA, which is University Risk Managers Association. Basically, they found that about 60% of their respondents who they surveyed are purchasing cyber liability policies. 7% of that 68% having done so within the last 3 years. I would echo that uptick over the last month or so. I've spoken with 4 or 5 education institutions who all thought about this coverage. And it's mainly due to the fact that universities have a very unique risk profile when it comes to cyber. They have healthcare information with students, if they have student-run clinics. There's a bit of retail exposure with bookstores, and they have to balance the fact that they need to have information oversight, yet to allow for the free flow of information and ideas via their network. And there's kind of an inherent conflict of postures within a higher ed institution that some really have a hard time getting comfortable with. You combine that with the fact that year over year, higher eds over large groups of people, aka graduating people, versus with business, you have very low turnover. You have a handful of people leaving on a quarterly basis, whereas with higher eds, it's almost like a cruise ship departing. You're having large quantities of people leaving and then large quantities coming in. So the risk is there for higher eds, and we're seeing that in our conversations with clients. So there's a higher ed breach, the breach of their engineering, College of Engineering, that were traced to China. And this is, again, due to the sensitive information that engineering colleges hold. And, when you think about what insuring agreements would be triggered, you trigger all your first party. So you figure out what happened, how it happened, and if students of that college were impacted, you'd be able to notify them promptly. And if there's a suit, the third party would come into play. Community colleges was interesting because it dealt with one of the more unglamorous types of hacks. So an employee of the college sent an email, an employee who was working from home, sent it on her personal email because the email was too large to send via the university email, sent it to the wrong party. That accident was that it contained 35,000 student records and triggered notification for all of them. And in the bottom paragraph on the left there, addresses, birth dates, social security numbers, email addresses. Basically, it comes to someone's information. So, next slide. Penn State breach. Biomedical engineering design team's department was hacked. and much like the Penn State scenario, they would incur those first-party forensics costs, and the third party if a suit was brought. That's my high-level overview of cyber. I know we've had a bunch of questions, but if there are any more, feel free to shout them out.
At the folks, at the risk of the audio crazy, are there any other questions for Andrew at this time?
Question, if it's all right.
Yes, yourself, please.
Good morning, everyone. This is Costas Torregas. I'm on the leadership team in National Cyber Watch Center, professor at George Washington University. That excellent presentation. The question I have for you is, do you have a feeling that this market of cyber insurance is kind of at 10% now, at 50%, or at 90% of capacity? And if it's not as high as you would like to see it as a broker, what are the major impediments you see before the insurance can really take off? Thank you.
Yeah, great question. So I don't know if I can put a number on where we're seeing the capacity right now, but the capacity has a long runway to go. So you think about the amount of carriers or insurance companies in this space. There's approximately 60 to 70. The overwhelming majority of those will only write excess policies, and what that means is that they're not going to be the primary risk. So as far as primary policies go, primary underwriters, we see about between 5 and 10, we'd say, that can write large organizations on a primary basis, and then another 50 to 60 will then sit on top of that policy, much further removed from the actual risk. And keeping it from becoming as robust as it needs to be is lack of information. And so, as someone asked earlier, there's not a lot of actuarial information on this stuff. And seeing carriers enter the cyberspace in two ways. They're doing it one way by offering very low limits on policies, so that $1 and $3 million policies for organizations, so they can kind of get their feet wet and see what the claims data looks like. And then the other way, which I would say is the more common way, is we're seeing carriers enter the space only sitting high excess towers. So when you think about that, say you have a prime policy of $10 million, and then you have a $10 mil excess layer on top of that, and a $10 mil excess layer on top of that for a total of 30. A lot of these brand new carriers will sit excess of 30 only, or excess of 50 only. And the logic behind that is that they're very far removed from the risk, so they don't expose themselves a great deal, but they also get to see claims data when it comes in, because when that primary policy gets notified, it has to be notified about the claim, and so then they can begin to build a database of information that they can be more comfortable with to eventually get down to the primary level.
I can ask a follow-up. So why don't you see action from organizations like the Insurance Services Office or others whose job it is to help insurance carriers organize data in a better way? This is reminiscent of where the property casualty insurance was in the 60s and 70s. There was no credible data.
Right. I think it's so new at this point that I think in the next 2 or 3 years we'll begin to see that, from other outside organizations to help standardize everything. But right now it's almost kind of the Wild West in the sense that the policy language and the policy forms are all very different from one another. They all have the same insuring agreements that we discussed, but the nuances of how those agreements are worded are very quite different. And there hasn't been a whole lot of and I think as we progress, we're going to see outside organizations like that become to get involved. And that will be an interesting thing to look for in the coming years.
Great questions, Costas. Andrew, I had a question for you. So how would a higher education institution purchase cyber, who they talk to, and how or why a broker like Aon can help.
Yeah, what they would do, the first step is hop on the phone with a broker and just kind of talk through, your thoughts and concerns, and the broker, such as myself, would be happy to walk through some specific examples and exposures unique to your organization. After that, I think it's very helpful to just take a look at a cyber application. As I mentioned, this is a great way to prompt an internal dialogue because with a cyber app, you're going to need to involve risk management, finance, and legal. It's very much a collaborative process. It's a way to get buy-in on this risk from outside the risk management department. And after you look at the application, you can complete the app. Then the broker can get quotes for you, and you can see if this is something that you would be is feasible within your organization's budget, and go from there. Are there anyone?
I think it's good to point out that part of involvement with Risk Solutions is to gauge our members' interests and needs, right? And that's certainly part of the reason for this webinar. Let me ask you this: typically within higher education institutions, who are the folks you're engaging with? Is it the director of facilities? Is it the CIO? Say I'm a faculty at a college in Nebraska, right? Is it typically the CISO, right? Who within these higher ed spaces are you dealing with primarily?
The main contacts that we work with are risk managers, and risk managers will bring in the CISOs or the CIOs to kind of get the more granular details. But it typically begins with risk management or finance, who's ever in charge of purchasing insurance. And then it's about getting buy-in internally, typically with the IT folks, about the fact that this is something that is not, in fact, a slam on the competency of them at their job, but basically to a property policy in the sense that just because you have great sprinklers in your building, it doesn't mean you shouldn't buy property insurance. It's getting to that point with having the discussion internally with the IT folks is that purchasing this policy is not something that is in any way a reflection on it's something that we need to do because it's the best practice now. But it begins with risk management and finance.
Management of finance. And what would premiums look like for higher ed institutions?
So it depends on the size of the institution from a revenue standpoint. Higher becoming a bit more difficult to write even over the last 2 months. Over the last 2 months, we've seen 2 high-profile data breaches of universities, one at the University of Central Florida and one at the University of Virginia. And so from a pricing standpoint, it typically ranges between, depending on obviously subject to all the underwriting information, from $8,000 for a million limit to $20,000 for a million in limit. And so the policies come in typically $1, $3, $5, and $10 million options. Multiply 8 by that limit and multiply 20 by that limit. I think that will give you a broad window.
We have time, I think, for one more question, which is, do institutions have options for different deductible levels, retentions to lower their premium?
Absolutely. So that's the easiest way to impact premium is adjusting the retention. And so we can typically see 5 to 15% reductions depending on how big of a retention we take. If you're at $1 million retention and you're not a very large institution, you're going to get some price breaks. But the retentions do eventually bottom out. So there is a certain point where retentions do not matter anymore. But you'd have to be taking on a pretty monster retention in order to get to that point.
Well, thank you very much, Andrew. It's a fantastic presentation. I think a really interesting topic. Obviously, a lot of interest from our community. Great questions. I want to thank everybody for joining us. Look for a follow-up email from CyberWatch with links to the presentation slides and the recorded webinar. And join us April 28th, which is a Thursday at 2 p.m. Eastern Time for our next webinar, which is about threat intelligence and a new partnership that CyberWatch has going on with Threat Connect. So take care, everybody. Have a good weekend. And thanks again, Andrew. Take care.
Thanks.